Good morning, everyone. Welcome to this new webinar by the International Energy Agency in our program for Ghana on capacity reinforcement on energy data and modeling. So today we will discuss more energy modeling, and we will look at the power sector more specifically. So my colleague Yasmin Asalan will present to you the work we are doing at the IEA and really explain in details how can we model the power sector. And she will join us at the end for questions and answers. Reminding you where we are in our online course. So this is the second week. We are still discussing energy modeling and now looking at power. Yesterday we discussed how we can make projections on what the future energy demand will be from an end use sector, taking building as an illustration. Once that we know how much electricity we want for lighting in houses, for powering appliances, likewise how much electricity we want in the industry sector, we have our future electricity demand, and today we will ask ourselves how can we meet this demand, how can we develop and size the power system to be able to match this demand, looking at conventional sources of power generation, but also renewable, which can be variable, and how to integrate them in the system, and also looking at the economical consideration. Tomorrow, we will look at how we can supply primary energy like hydrocarbons and oil and gas in our last webinar of the week. As usually, this webinar is recorded, so if you miss, you have an opportunity to watch it again on YouTube. Any question, please raise your hand, use the Q&A box, or send us email. Sorry. So as a start, I'd like you to go, as we do usually, to menti.com for a first series of polling questions. So looking at sub-Saharan Africa, excluding South Africa, for the year 2019, I'd like you to rank the end-use sectors and subsectors according to their electricity demand. So from the highest to the lowest. So according to you, is industry demanding more electricity than agriculture or than service, transport, residential, etc., in the specific scope of sub-Saharan Africa, excluding South Africa? Thank you for your first answers. It's very interesting, and it's very close to what our numbers show, because indeed in sub-Saharan Africa, without South Africa, residential is a #1 sector in terms of electricity demand, and then comes industry. But the two are very, very close. It's between 75 and 80 terawatt hour each. So those two sectors are really leading and making the most of electricity demand. Number 3 is services, which are also related to buildings, but services only makes half of what residential or industry accounts for in terms of electricity demand. And very low and last come agriculture, with in sub-Saharan Africa is not a sector demanding much electricity, and then transport even lower. Even though we see some countries with plans to develop electrical mobility, especially for 2-3 wheelers, but also for electric cars. But so far, this has not translated into much real demand for electricity in the continent. So so yeah, here on the picture you have the right order, which is exactly what you have voted for. So congratulations. And moving to the next question. So according to you, can we expect that the electrification of final uses will decrease, remain stable, or increase in the future? Okay, so the answer might be straightforward, and you are all voting for increase. Actually, it depends on the context, but in the case of emerging and developing economies, or in the case of sub-Saharan Africa, yes, it is meant to increase a lot. Then we can have some specific dynamics depending on the region. In Europe or in China, in the US, in OECD context, transport is already electrifying a lot, and this is set to increase further. Whereas we also expect further electrification of industry, of building sector, and in the case of sub-Saharan Africa, we expect all sectors to electrify further. So thank you for your answer. I'm coming back to the presentation, and I'd like to share with you a few of IEA analyses and findings on the power sector before we enter more into the modeling and the technical part itself. So why are we looking at the power sector today? Why is it important? First, because it's important in all the energy consumptions for all sources. So here you have two figures looking at the world, and you can see that the share of electricity um, for the end use sector is high. So TFC means total final consumption, and electricity makes almost 1/4 of the global needs. It will depend by the sector, but for residential services, it's a very high share. And when we try to translate that into the energy-related CO2 emissions, electricity accounts for 40% of global energy-related CO2 emissions. So it is a central sector for any decarbonization strategy. So this is the global situation. When we look at Africa, we have the same dynamic, even though, as we just said, the electrification of end-use sector is lower. You can see that electricity share in total final consumption is at somewhere a bit above 10%, but higher in industry or in services. And regarding CO2, the role of electricity in CO2 emissions in Africa is similar to the global average at around 40%. Okay, now let's look a bit at what happened at our historical data. Here you can see electricity demand per region in the year 2019. So you would see the main electricity demanding regions, China, the US, Europe, appearing on this chart. When we looked at what happened in the year 2020, which due to the pandemic, to its subsequent lockdowns, has been a very difficult and very exceptional, extraordinary year, you would see that electricity demand has decreased globally But electricity has been relatively resilient to the COVID-19 shock because um, electricity demand declined by only 2%, whereas there was a 5% decline in all the energy demand. So electricity more resilient. And depending on the region, the dynamic have not been the same. You would see that in the US, Europe, it has electricity demand has decreased, likewise in India, but in China, electricity has increased, which means that in China, the level of demand had returned to pre-COVID levels just in the second half of the year or in the very few months following the first pandemic wave and crisis. Looking ahead, looking at the future, in all our IEA scenario, we see electricity demand returning to growth in all regions very quickly in the very coming years. And if you look at regional dynamic, we expect electricity demand in China to double by 2040. And then we also expect India to be the fastest growing region with a 5% rise per year in terms of electricity demand over the coming 2 decades, which would mean that India would become the number 3 power system, overtaking the European Union. In Africa, we also expect a doubling of electricity demand by 2040. And when we try to think of the sources of demand growth, it seems that the face is a bit changing because we have traditional sources of electricity demand that will continue growing, like electric motors in industry, like household appliances, especially in Africa and in other places where we expect higher level of incomes and industrialization of the countries. But there are also new sources for the growth in electricity demand, namely space cooling needs, digitalization of the entire economy, and increasingly the electrification of transport. If we look at the supply side, so what will be the new sources of power to meet this demand? So what happened over the last 2 decades was that coal was really the king of electricity because it was the most developed source of electricity generation, increasing more than any other source. But the future will not be the same as the past, and there is already been a revolution and a profound transformation starting because over the last 3 years, solar PV has been the most built technology, and we expect solar PV in the coming decade to be the number one growing source of power generation. So solar PV is becoming the new king for electricity. And this is under our steps, so stated policy scenario. The potential is much higher. If we look at our sustainable development scenario, we would see solar PV over the coming 20 years to increase really to skyrocket and to reach level of 8,000 terawatt hour of electricity generation from solar PV, which is equivalent to 12 times what solar PV generated in 2019. And reasons for this growth of solar PV are sharp cost decline, but also policy support and cheap financing for developing infrastructure. So looking at investments, here is an analysis we did also 2 years ago on what will be the investment needs in Africa for the power sector. And you may recall our two main scenarios, stated policies. So what is expected to happen under announced and backed policies, and our Africa case, where we want to reach universal access to electricity and enhanced and inclusive economic growth. So under this Africa case scenario, we would expect investment in the power sector in Africa to be multiplied by 4. And I like to remind that today's level of investment in Africa in the power sector are very low. Africa is only accounting for 4% of global power supply investment, despite being home to almost 20% of the world's population. And when we look at a per capita investments in the power generation ratio, we see that those numbers have not grown in Africa since the 1990s. Whereas in India, in Southeast Asia, the level of power generation capacity per capita has really rose very sharply. So there is a need to scale up investments in Africa to expand both the electricity networks and the generation capacities. And the question is, are there funds available for that? How do we fund this quadrupling of investment? And here, trying to answer this question, we have looked at how much these investments are expected to account for the GDP of the region. So depending on the scenario, this would mean 1.5 to 2.5 percentage of the GDP. And this is less or similar to what India and China have been able to achieve over the past 2 decades. So mobilizing such level of investment is challenging, but we think it's achievable. So these were just sense settings information on the power sector in Africa according to our latest analysis. Now I like to give the floor to my colleague Yasmin, who will really explain to you more into details how we can model the power sector, how do we make estimations, and how do we play with tools to understand how supply can meet demand for electricity in the future.
Hello, everyone, and welcome to this session dedicated to the power sector. My name is Yasmin Arsalan. I'm a power sector modeler and analyst within the World Energy Outlook team here at the IEA. So today, together, we'll look at the basic principle and characteristic of the power sector. We will first have a look at how it's functioning without wind and solar PV. Then at the end of the presentation, we'll come back to these newer technologies and see how they are impacting the power system's operation. As we all know, power systems are very complex systems. They have a multitude of actors, multitude of elements and interaction between them. I'd like to focus on the most important one here. So first, the demand side of things. You can see here the different centers where electricity is consumed, be it a household, be it industries and businesses, commercial facilities. Second, then on the supply side of things, where this electricity is produced. So this is the generation facilities. And third, between those two groups, you have the grid, transmission, distribution grids, and other related infrastructure, and the grid that connects those two broad groups. So this is for the grid connected element of power systems. You have, in addition, some off-grid elements. They can be divided between mini-grids and standalone systems. This has been generation centers to demand centers. And now this traditional way at looking at flows is becoming blurrier and blurrier. You can see that now more and more consumers are generating their own electricity and injecting it into the grid. So this traditional unidirectional flow is becoming more multidirectional. So that is on the national grid side. On the off-grid side, we can think that some off-grid elements can at some point be integrated in the national grids. Mini grids can be connected at some point in time to the main grids. So this presentation, we will look mainly to on-grid system, and we will leave the off-grid ones to a separate webinar. Today, we will focus mainly at the supply side of things. We will focus really at the generation part of the power sectors. Of course, demand side is really important. Electricity demand level, electricity demand shape will really impact the power sector's operation and their evolution over time, over the course of the year, over the course of a month, over the course even of a day, or even at a shorter time frame, will have impacts on the operation of power sector generation. So more on demand. We looked yesterday at end-use sector energy demand. Electricity accounts for a very important part of it. At the global level, we are talking about 1/5 of end-use sector energy demand that are met by electricity. And if we consider that electricity has a higher conversion efficiency compared to other fuels, other energy vector, then this share of useful energy is even much, much higher. Going forward, one very important characteristic to keep in mind when we are talking about electricity is that it cannot be stored in large quantities or for very long periods of time. We have some exception, thinking about large hydro storage facilities, for example. But the point is that it's very different from other energy commodities such as oil, such as gas, such as coal. The consequence of that is that we need to balance the system all the time. Electricity demand must be met at all time by electricity production. And for all this variation that we see over the course of the year or at even the second time frame. Until here, we looked at electricity demand. So this is sitting at this part of the world energy model. And electricity demand need to be balanced at all time, but by the electricity supply. So this is considered as an input to the power supply module of the model. In some other model, where final energy model is not as a part of the whole system, this would be considered as an exogenous input. So here we have final energy demand that is endogenous and that is feeding the supply part of power system. We also have a feedback loop from the power system to final energy demand, and this is reflected through the price of electricity. So electricity prices will determine also the competition that occurs between fuels in final energy demand section of the model. So if we look at this point with a very, very simple schematic, we can see how electricity demand is different from electricity generation. In electricity generation, we account also for the grid losses, the own use of power plants, some electricity trade that can occur between countries, between region. Let's think about power pools where trade can happen. So the total generation needs to be met by the producing facilities, which determines the electricity prices. And then there is this feedback to end-use sectors' demand. Now let's move on to the next section of this power supply modeling session. So we will touch upon more in detail what are the sub-modules of the power sector module in our model. So if we have a closer look at the power sector generation module, we have inputs flowing in. We need a lot of historical data, such as capacity by technology, by year. We need information on the generation mix, the fuel consumption. On top of that, each technology has a different feature. The cost, the capex of each technology will be quite important to drive our module. We have also learning rates, which will make this cost evolve over time as we have learning by doing. We need some grid elements, such as the length of the line, and also capacity factors. On top of that, some elements are linked to projections from other modules. So, as mentioned earlier, we need electricity demand from the demand module. On top of that, fuel prices that would come from the supply module, and CO2 prices in regions that have applied these kind of policies. Talking about policies, we have constraints also. Other policies than CO2 pricing can be renewable energy targets, but other constraints can be market or non-market related or technical. And as output, we are able to derive capacity, the network length, generation, fuel consumption, cost, investment, and electricity prices that would then be implemented as a feedback loop for electricity demand module. Now let's have a closer look at this black box. When we model the power sector, we need to remember that this is a multitude of submodules that needs to be considered. From distributed generation to nuclear generation. One of these modules, for instance, combined heat and power and heat plants, will have heat demand as a driving element. Water is a driver for this desalination one. Renewables need to take into account the available potential for each location, etc., etc. And as an output of each of these very complex submodules, we have the evolution of capacity, fuel mix in terms of generation and use. We have the emission, we have the investment and prices. So this is a more detailed diagram of the power sector module. Here you can see that there are two central points in this module. We have the capacity addition mechanism on the left. So this is the module from which we derive what type of capacity needs to be built to meet electricity demand. So the inputs in white of these modules are investment assumption, prices, efficiency, historical capacity, and retirement. We also have in green some calculation that would have an important impact on this module. Electricity demand, obviously, we build this capacity to meet demand. And we will look at this module first, then we will move on to the dispatch mechanism. Once we have those plants, this installed capacity, how do they operate? So maybe before digging in, an important consideration to have in mind here. When we are talking about the needed installed capacity in a power system, there are two components. We build it to meet demand, but also because our power plants have lifetime. So existing plant today will be retired in the future. And so new capacity addition will need to compensate for these retirements, and on top of that, increase to meet the new demand. So let's start with the capacity addition module. So we need first to remember a key characteristic of the power sector, which is that supply and demand must match at all times. And looking at demand, we have a constant variation over time. So here we can see the hourly electricity demand, and we can see how it changed over the year with strong variation among seasons, which would depend obviously on the country. If we could look at monthly changes, we see as well some variation. And during the week, we see higher demand during working days. And during the day, higher demand during daylight hours compared to nighttime hours. So to model power supply, hourly electricity model can be used. We have this kind of models here in the World Energy Outlook team for several regions, the United States, China, India, and the European Union. But this is quite a complex kind of modeling, and it requires a lot of data. It requires very powerful computing capabilities. So when we look at the annual granularity, we make some assumptions, some simplification to still consider the granularity, the time period granularity, but keeping it in a simpler way. A very common simplification is to reorder the hourly electricity demand from the highest point, the peak hour, to the lowest value. And this is what we call the load duration curve. It can be expressed in absolute value, or as you can see here, relative to the average electricity demand and in percentage terms. So for example, here we see that the peak is about 170% above average demand over the year. So this is how we proceed. We can divide this load curve in several homogeneous segments. And the most typical one being peak, mid, and base. So 4 periods of time here, the highest one being the peak segment, the lowest, the base load segment, and in between 2 mid-load segments. So given the evolution of electricity demand over the projection period, the evolution of total dispatchable capacity can be estimated through 2 steps. So first, the peak to average ratio. Remember this 170% above average that we saw in the previous example. So we calculate this peak to average ratio based on the analysis of historical data and the evolution of different end use, for instance, cooling needs or electric vehicles can make this demand peakier. Then to have more reliability on the system, it is not only the peak demand that needs to be met. We build the system to meet that peak demand, but we have a level of security. This is what we call the capacity margin. So an additional amount of dispatchable capacity to be sure that we have a reliable system, even if some plants for extreme reason like rupture of supply chains, etc., are down in a certain period of time, then we have this capacity margin on top of the peak demand to make sure that the system is meeting demand at all time. So coming back to the different time slices. So as we saw earlier, we considered a base load type of plant, mid load type of plant, and peak load type of plants. And for each time slice, the new additional capacity needs to take into account all these three different time slices. So we consider the net addition needed to meet new demand, and as mentioned earlier, the addition needed to replace the retiring plants. Back to the main diagram on power sector module and the two central points of power modeling. So we had a look at additions of new plants. Now we will look at the way to operate these plants once they have been added to the system. So if you look at this diagram, the main inputs to operate the plants are, of course, what is the installed capacity, which was an output, outputs are in blue, an output of the capacity mechanism. Once we have capacity, then the main drivers would be fuel and CO2 price, efficiencies, historical capacity, maximum capacity factors. And the output of this is generation by plants, and we will see at a later stage fuel consumption and CO2 emission by plant type. So we're really focusing on this part of the model. We have several dispatch mechanisms available when we model how plants operate. This is really aiming at determining which plants, which technology will generate in which point in time within the hour, within the year, given a number of constraints such as the availability and flexibility, the technical constraints of each plant type. So, given a certain level of demand and a certain amount of installed capacity, depending on the type, power plants generate electricity based on dispatching rules, usually on an hour-by-hour basis. What is important here is the utilization rate, meaning during a year, how often these plants operate. So in gray, baseload plants would operate generally with capacity factors or utilization rates around 80%. 80% of the year, baseload plant would be used to meet demand. Mid-load would be generally used 50% of the year, and peak load run very much less hours. Really, as you can see on the graph on the left, you see they're used really for peaky demand, and so they have generally much lower capacity factor, generally below 10%. Here in this example, we have 7%. So this is a very useful indicator, this capacity factor. It can be used in the modeling to add additional constraint on the maximum generation of a group of plants. For example, you could set as a constraint that gas turbine cannot be used more than X% of the year. This is used to simulate operational constraints and also grid bottlenecks. One of the most common and most efficient dispatch system is the merit order. So what is the merit order? This is an approach, a least cost approach based on variable costs. This variable cost, we look within each hour, which is the best suited plant, which is the least cost plant to generate. So we rank plants from the lowest to the highest variable cost, measured here in dollars per megawatt hour, also taking into account the maximum electricity that they can generate in that hour. This diagram shows the level of electricity demand on the x-axis, and it helps determine which plants will run, and the consequence, the implication is the price. For example, for baseload plants, the off-peak price would be determined mainly by nuclear, lignite, and steam coal during baseload hour, mid-load, and also for peak load demand. When we average this resulting price over the whole 8,760 hours of a year, we can determine the average electricity wholesale price, the average annual electricity wholesale price. So why is the dispatching mechanism important? This module helps determine a number of very important elements. So how plants are operated over time, how much electricity is produced by each technology, which plants will be generating, and then, and I'll come back to that later, the fuel use and associated emission. And we saw that just in the previous slide, the price. And to sum up, the result depends on many factors. So from the capacity addition mechanism, which plants are here in the system for each year of projection, what are the relative price of coal, oil, and gas that would impact the variable cost and therefore the merit order? Is there a CO2 price that would penalize the most carbon-intensive technology? And again, the changing level of demand. A quick illustration of the result of the generation module for a very specific case that we took from our World Energy Outlook 2019, and especially the focus on Africa. So here on the top, we can see the evolving demand over the period and for different scenarios, and how electricity is generated, what are the different sources of electricity in those three scenarios, the stated policy scenario, the Africa case. So we can see clearly that in the Africa case, demand increased almost eightfold, and here gas, wind, and solar are meeting most of the demand growth. Coming back to the diagram, we have now covered the two main components, addition of new plants and dispatch mechanism. To follow, I would like to focus on other very important elements of this power system, which is how much fuel is consumed by plants and the consequence of it, the CO2 emission by plant type. So once we have electricity generated from the dispatch module, one key element to consider is the efficiency of these plants. This is really key to determine the overall efficiency of the park and therefore the fuel use by type. The fuel use by type is really important when considering domestic production, considering energy security consideration, etc., etc. So how much oil would need to be imported, how much gas is very much linked to fuel use consumption in the power system. And from generated electricity, we derive that using efficiency of plants. So over time, technical improvements and with aging plants out of the park and more efficient new plants coming in, we can see the evolution. In the OECD region, this evolution is really minimal, but as you can see in China and India, as the demand is decreasing much faster, we have much more new plants coming in to meet that demand, and these new plants are generally more efficient, having a big impact on efficiencies in the park. Once overall fossil fuel use is determined from electricity generation using efficiency, we can derive the total CO2 emissions of the power sector. As you can see in the graph, the increase of electricity generation can be balanced by a decrease of the average emission per unit of electricity generated. This can be linked to two main factors. First, each fuel has a different carbon intensity, coal being the most intensive one, whereas gas is the lowest intensive technology. So a shift from coal to gas would have an impact on the CO2 emission per electricity generated. The second main driver is the efficiency. The efficiency would limit the fuel input per electricity output. So to pursue climate goals, CO2 intensity will need to be strongly decreased thanks to the massive deployment of low carbon technology, but also thanks to a shift to lower emitting fossil fuel technology and improvement of new technology so they are more efficient.
Okay, so we have some time to take some questions. So I hope that you found the explanation clear on how to deal with those two main questions for the power sector, how to develop the power capacity, how to install new plants, and to manage the retirement of existing power plants. This was question number two. And number one and number two is, once we have our operating fleet of different type of power plants, how do we dispatch them, which one to be used depending on if we are trying to meet base, middle, or peak demand, and what are the implication in several modeling and calculation. Okay, so if there are no more questions, I suggest I have some for you. So let's go back to Menti using the same code. Okay, you should be able to see the Menti page. So still using the code 3905955. The question now is, looking at sub-Saharan Africa without South Africa in 2019, according to you, which is the largest electricity producing source? And we are producing all the potential sources, so including fossil fuels, coal, oil and gas, renewables like hydroelectricity, wind, solar, geothermal, or bioenergy. So in looking at this scope, which is sub-Saharan Africa without South Africa, according to you, which is number one electricity source? So this question is interesting, and we have been asking it also to other countries which are part of this reinforcement capacity reinforcement program. And actually, one thing which is striking is that electricity mix in different countries are very diverse. For example, in Senegal, more than 90% of electricity generated comes from oil. It's heavy fuel oil. So they, when asking the question for the entire region, there were many answers looking at oil because in the specific context of Senegal, that's the number one resource. On the contrary, when we asked the question at participants from Zambia or DRC, which are countries where hydro is accounting for more than 2/3 or 3/4 of the electricity generation, they were also very much voting for hydro. So there are very different energy mix. Looking at sub-Saharan Africa without South Africa, electricity is indeed number one source for generating. Hydroelectricity is the number one source for generating electricity. It accounts for more than half of electricity produced, or 125 terawatt hour. Then number two is gas, accounting for a quarter of the remainder electricity, and then oil, coal, while modern renewables, including wind, bioenergy, solar PV, and geothermal, only account for less than 5%. Again, very country dependent. South Africa is very much relying on coal. So if we had included them in the scope, coal would be much higher. Looking northern, if we look at North Africa, gas is really a very important source of electricity there, as well as oil. So that will also change the dynamic. But for the considered scope, hydroelectricity is number one. Next question. So this was the picture in 2019. According to you, what has been the evolution over the past 5 years? So which source of electricity has most increased between 2014 and 2019? Okay, so you are mostly voting for solar PV and gas. Actually, the number one energy in terms of growth over the past 5 years has been solar PV, rising at a rate of 30% per year. If we look at a longer period and looking at the entire decade, wind has been the fastest growing source of electricity. But you should keep in mind that the starting levels were very low. So that's why the growth pace are really higher. But we anticipate that those sources of energy will continue to rise very, very fast. And we also expect a role for gas in electricity generation in the continent. One last question, which is open. What comes to your mind when we mention solar PV? What are the first characteristics that you think of? Okay, so clean is the first word, and indeed, when we look at CO2 emissions, solar PV is amongst the cleanest sources to generate electricity with little to no emitting factor. Actually, there is no emission when generating electricity. There are some emissions related to the manufacturing, the transport of the equipment, but well, for any object, any device or equipment, there are obviously related emissions for construction, transport, etc. So indeed, it's a very clean technology, environmental friendly in that sense, of course. Intermittency is indeed a characteristic because it only produces electricity when there is the sun, so during daytime, and it will evolve depending on the clouds coverage. Um, it's interesting. Someone is adding expensive, so the cost of solar PV has been declining very, very fast. Maybe this has been the fastest cost decline in energy technologies we've observed over time. So costs are changing quickly, and as of today, for most countries in the world, solar PV is the cheapest source for power generation. I can also see panels, future, no emissions, which are indeed all relevant characteristic. So thank you very much for your inputs. I just want to show you the energy mix, the electricity mix in sub-Saharan Africa today and some projections. So as we just saw, if you look at the year 2020, you would see that the mix is dominated by hydro. According to our stated policy scenario, we expect this mix to diversify with a higher role for solar PV, for gas. And in the Africa case, where we have a really sharp rise in electricity generated in the continent, we can see that natural gas would pass hydropower as the largest source of power supply, and the share of solar PV would rise to 25% of all electricity generated in the continent. This is for sub-Saharan Africa. If we look more specifically at the analysis we conducted for Ghana, we can see that today Ghana has also a diversified mix, half of it coming from hydropower and the rest coming from domestically produced gas and oil. in our steps scenario, we expect demand to rise very sharply again, and we expect gas to play an important role, as well as solar PV. So let's move to the second part of the teaching, with entering more into the economics of power systems and how to integrate variable renewables like solar PV, which, as was said, are intermittent.
So we already looked at some economic concepts when we discussed the merit order and variable costs. I'd like now to expand a little bit more on that. And so in this section, we will now touch upon some other quite important aspects of power system economics. One very important aspect is how to evaluate the competitiveness of the different electricity generating technology. So competition depends on several factors, of course, cost component, but also when the plant is used, the time of use, and where. For example, if there is a grid congestion in the specific location. And it also depends on the value side of things, the value of electricity generated, and prices, of course, which could be higher generally at peak demand time. A very common indicator that is used to estimate the cost of producing electricity is the LCOE, the levelized cost of electricity, representing the cost of technologies over the project's lifetime. And we can see some indicative values for some of these technologies in the screen right now. The LCOE is measured as average cost per output of electricity. So here, for example, in dollars per megawatt hours. This metric really does a great job actually at putting together all the various technology costs. So talking about the cost to develop, design, license a project, the capital cost to actually build the plant. But then, of course, over the lifetime, which can range from 20 to 70 years, you would have also to pay for operation, maintenance costs, as well as input fuel and CO2 prices when applicable. Of course, on top of that, you would have the financing cost along the way that we generally call the weighted average cost of capital. So this can be quite a significant and disparate set of costs, would depend on the technologies. And we can see here how the LCOE really does a great job at putting them together in this general formula for calculating the LCOE. We have a more simplified form as well. So the idea now is not to look in detail at this formula, but I would like to highlight one point, that we have two main components: the variable cost that we use also in the merit order, and the fixed annualized cost. And these two components, they change according to the type of plant, and also the proportion, the relative importance is different depending on the technology. One quick example here to illustrate that point is to look at LCOEs by technology in the United States for 2017. Typically, low carbon technologies such as nuclear, wind, and solar PV, they have a high fixed cost and very low variable cost. On the other hand, gas, and to a lesser extent coal, are the opposite. They have high variable cost, and compared to that, relatively lower capital cost than low carbon technologies. Another point to highlight is that financing can be quite a significant proportion, especially for capital intensive technology. And if you have to pay a rate that reflects a very high market risk, then financing can be more important than the actual cost to build the plant itself. One of limitation of the LCOE, and especially in the simplified formula, is the capacity factors that are used is often fixed. So another very useful way to look at things is to see how the cost of power plants is changing depending of the amount of time these plants are used. So in the screening curve is what we call this, this way of looking at things. In the screening curves, you would look on the y-axis as at the fixed annual cost, and it would show how the cost would increase over time, over the time of use over the year, depending on how variable costs are evolving. So this really show different type of technology, and it's really helping us to see the least cost pathway, the least cost solution for each type of utilization, meaning at peak demand, when the numbers of operating hours are really low, up to the base load operation of power plants when they operate all the year 8,760 hours. So you can see this least cost path in the screen right now. What is also very clear with this graph is that the power technology, they really provide different services. So we can consider nuclear power and coal plants very well suited for baseload operation, the baseload category. So it actually makes sense to compare them in terms of LCOEs. But it would be very difficult to compare a nuclear plant and a gas turbine or GT, which usually provide peak power, as we can see here. Another point is that this curve is valid only for dispatchable plants, and therefore wind and solar PV cannot really be included. They run when the wind blows and the sunshine, so they don't really fit very well in this traditional categorization, baseload versus peaking plant technology. So the question is, for this technology, can we really compare the LCOE to dispatchable technology? So that's one of the limitation of LCOE, especially for renewable plants. So as mentioned, LCOEs are very widely used, and this is because they allow to present in one concise number the generation cost of a plant over its lifetime. There are, however, some limitation, and we really need to keep them in mind when we are using this indicator. I will focus on one of the key limitation here is it doesn't include the value of electricity generated. So basically, if you are an investor and looking at LCOE, you must keep in mind that it doesn't encompass anything on the revenue side of things. The second limitation is that making comparisons across different technology is complex or wrong. You need to go beyond and look at the screening curves as we did earlier for dispatchable technology. And this screening curve concept cannot be applied to renewables technology because of these categories between peak and base load plants. So we really feel the need to go beyond this limitation. It does a great job, but we want to go beyond to overcome this limitation. And that's the concept that we've been developing here at the IEA with the value adjusted levelized cost of electricity. So the value adjusted LCOE is a new metric for competitiveness, and it really aims at combining costs and the value. And this is really the cornerstone of this concept, combining both. It is using information from hourly modeling of electricity demand and supply, so that we can have information on how the power system operates on the hourly level, but also prices. And prices are really important to reflect the value of producing electricity in any given hour of a given year. So back to the concept of VALCO. On the one side, you have the LCOE metric that gives you the single cost number. And on the other side, you have the system value. And we can see here 3 broad categories. And these categories are kind of mirroring the new market design that we have seen emerging in many countries, thinking about the European Union, US, Japan, but many others are looking into explicit pricing of electricity services. So the main one is energy value, which represent the value of electricity production on a system at any time to meet demand. So in wholesale markets, which are widely represented over the world, this would be reflected by bids to sell electricity in a given hour. The second category is the capacity value. So it reflects the contribution to system adequacy. Capacity market exists in a number of regions with payment for power plants that can contribute to the reliability of the system. So basically, we can think of it that as being paid for being here when needed. And the third one is on the flexibility side, that encompass all additional services that really ensure the quality of electricity services. And this kind of services, they are generally valued through ancillary service markets that are also emerging in some countries. So the concept behind the VALCO is taking these costs, these values, and merging them. So the energy value is the one that really has the most impact. Selling electricity is today the largest source of revenues in competitive markets. And of the 3 categories of values I showed earlier, this is the energy values that changes the most across technologies. So showing now some hourly outputs with demand trends over the course of a sample day in the European Union in 2030. You can see these demand trends represented by the blue line. And you can see also the various supply technology that contribute to meeting that demand. So early in the morning, around 4 a.m., wind production is significant. And this is a time when demand is relatively low. So this leads to an excess of supply, and other plants are therefore ramping down. On the other hand, you can see also a need for a big ramp up of electricity output during the evening peak when people are getting back from work. So reflecting these changing needs over the course of the day, the market price changed quite significantly from zero price in terms of excess to higher price at peak time. So when we do that, not only for sample 24 hours, but for all 8,760 hours of a given year, we can actually derive the price received by each technology. We can then average it over the year. It can be thought as if it was the revenues from selling 1 megawatt hour of electricity on that given year. And that's what we call the energy values. It varies across technology. Again, dispatchable technologies, and particularly the most flexible ones, they are really able to capture those high prices at peak hours. So it means that their energy values is higher than the average of the system. And this, even if they run less hours. For this particular European system, you can see as well that wind and solar, especially solar, produce when it's less needed. So in that case, they have lower energy values. That's basically the idea of the energy value for each region for which we have hourly models. So this is the United States, the European Union, China, and India. We derive from hourly operations the annual energy value for each technology. And we do this for every year projected in our outlook and for all our scenarios. So from this hourly information, we can derive also the capacity value, so the contribution to system adequacy. Can you rely on this technology to produce electricity when the system needs it the most? Dispatchable power plants are generally available in all hours, except in extreme cases such as disruption in supply chain or extreme weather, for example. And they have high capacity value. They can generally contribute to something like 80% of the peak or even above for some technologies. And for variable renewables, it would really depend on the degree of variability and how the output of solar, the output of wind is adequate and coincide with system needs. So in this example of the European Union here, we can see that their lower ability to contribute to the evening peaks would mean a lower capacity value. A quick word on the flexibility value. This is really the most difficult one to represent. In the ancillary service market in Ireland, we have more than 20 products from primary, secondary, reserves, regulation, frequency controls, and it is very difficult for a global model such as the World Energy Model to represent that kind of details. So our representation is really derived from this real world existing ancillary markets value, and we take into account how it increased with the rising share of variable renewables as it is quite obvious that this flexibility values is linked to the ramp up of these energy sources. Now, keep in mind that this is an example, and this is very specific to the European Union demand and supply pattern. It would look very differently in a system where the demand peak is more aligned to, let's say, solar output. We can think of a warm country, a sunnier country, and in that case, the peaks occurs generally at noon, and this is very well suited to solar PV, which can be able to meet cooling needs linked to this particular system. In that case, solar PV would be able to capture at the same time peak hour high prices, and also to better contribute to the adequacy and have higher values. Now, how do we put all the pieces together? For a particular technology, we start with the LCOE. Then we would simulate in a given year the energy value for this technology. We do that for all technologies, so we are able to compare to the average energy value of the system. So here, for this very illustrative example, we can see that the technology has a higher value than the average of the system. So it means that it is more competitive. More competitive means that we need to adjust the cost and reduce it to reflect that. So this is what we do. We take the difference with the average energy value of the system and make this adjustment on the cost side of the metric. Now on the capacity value, the contribution to adequacy here is relatively low compared to average. So that means that the technology is less competitive than others on that specific category. Less competitive, therefore more expensive. And now the flexibility value. Again, not a very high value compared to average. Less competitive, we adjust by increasing the cost side of things. So we take all these three value adjustments, we apply them to the LCOE, which leads to the value adjusted LCOE, the VALCO. So now to summarize the VALCO concept, it does provide a more sophisticated metric of competitiveness. It includes these elements of value that the LCOE was missing, and it makes it robust across a wider set of technology. It is not perfect. A few of these limitations includes that they are not site-specific, so the network integration cost, for example, is not there, and it doesn't include externality costs that are not priced. So, for example, air pollution. The VALCO is not the only metric looking beyond the LCOEs. For example, cost and benefits aspects are already taken into account in profitability calculations, such as the net present value. We have also some academic research looking into it. The US Energy Department, they also have similar metrics. In the real world, we have some application of very similar concepts in some auctions in Mexico, for instance. So to conclude on this concept, it's really part of a bigger family of beyond LCOE metrics that aims at providing useful information for energy modelers, system planners, and investors. And talking about investors, a very important outcomes of models is the amount of investment that is needed overall in the sector, and for each technology type, as well as all the related infrastructure. So beyond spending on power plants that we would derive from capacity additions and their unit capital cost, we also see here that electricity networks also need to be expanded, maintained, and digitalized. So we model this network through a dedicated module that derives transmission and distribution grids infrastructure really needed to support the expansion of the power system and also modernize existing aging assets. We have additional constraints to the model that can be added to simulate more real-life investment constraints. And there are really important policy implication, market implication that can be derived for this investment to be really happening. Otherwise, the lights would not be kept on. So this kind of really coming back to the Valco, so that really highlights the need for investor and policymaker to have the right signal for investments. So the Valco concept is really important to improve the LCOE concept in order for them to have a clearer picture of competitiveness across technology, which is really essential to develop long-term plans and long-term goals. So I would like now to summarize the main calculation that we've been through: installed capacity, electricity generation, fuel inputs, CO2 emissions, but also kind of recall the relationships among these main elements. So we have capacity factors and merit order that are linking installed capacity and electricity generation. We have efficiency that connects electricity generation and fuel inputs. Fuel inputs and CO2 emission are related through emission factors. When we have gross capacity addition, then this helps us to determine the evolution of overall capacity by type. And we can calculate total investment thanks to unit investment cost. And all of these elements are related between them, and they are summarized using the LCOE metric despite its limitation. We have now reached the last part of our presentation on the power sector. And for this very last section, I would like to introduce the basic principle of the concept of variable renewables. What are their constraints? What are the solutions to integrate them into power system? So why are we looking at wind and solar PV technologies? The answer is quite easy. They really represent the biggest change and success story of the last 15 years. Solar PV is the new king. It's the most built technology over the past 3 years. It's the cheapest source of electricity in most countries over the world. And beyond these recent trends and historical trends, we see looking forward a greater role, a greater share of this technology to decarbonize power system in the future, to decarbonize the whole economy. But a point to keep in mind when we are talking about wind and solar PV is that the electricity generation, their output, is really depending on the underlying natural resources. And we can see on this slide how these outputs evolve over time because they are linked to the natural resources, they are linked to meteorological conditions. So this variation can lead to several consequences that can be summarized with really 3 main characteristics that would be scarcity, abundancy, and variability. Scarcity is the situation that happens when these non-dispatchable renewables, these variable renewables, they do not provide enough generation to cover demand. So this requires other type of operator, other type of plant units to ramp up to meet demand. The second point, abundancy, is the opposite. It's when we have too much generation, too much output from wind and solar PV in the system, which leads to excess generation compared to demand. We saw an example earlier with the European Union. Then the third category, variability, is really the extent and the speed of the change of the outputs. For instance, the speed at which solar PV ramps up for the noon peak and ramps down when the evenings come, that needs to be compensated by other means of production. The impact of variable renewable energy sources would also depend on the level of deployment. At low level of penetration in the mix, the effects are really negligible. Power systems were built already to be resilient, to be able to accommodate the variability of demand. And when solar PV and wind share is low, the variation of demand from 1 hour to another is more important, has more effect on the system than this variability coming from solar and wind PV. But when we go beyond that, we begin to see some impact. Impact on total installed capacity. One key issue is the higher flexibility needs that would be needed from the system, the higher ramping requirements. There is an impact on the load duration curve, an impact on dispatch, on prices, and consequently on market design. And finally, an impact on how the network is used, on how the network can accommodate this variability. On the impact on the load duration curves, we first need to introduce a new concept, the concept of residual load duration curve. So we can apply all the reasoning that we discussed earlier to this residual load duration curve instead of the load duration curve that we saw earlier in the presentation. So what is this residual load duration curve? We take the hourly electricity demand, so here over the month of January, and then we would need to subtract the generation of the variable renewable energy sources. Here, this is solar PV. And the result is the light blue curve, the residual demand. Then, same concept as the load duration curve, we reorder the hourly demand from the highest to the lowest. And depending on the penetration of solar PV, you can see different impact, the biggest impact being the one with 60 gigawatts of solar PV. Looking at this example of 60 gigawatt and focusing on it, we can see that it generally has a main structure, but steeper than the original load duration curve, with big differences for base load and for peak load generation. This is a peak here, load duration curves that requires less base load production means. We can have a clearer view of this phenomenon in this slide. where we can see how this would impact the total firm capacity needs. They do not change significantly overall, but as mentioned earlier, more peakier needs and less baseload needs. Now, zooming in a day, a sample day. So here again, the same concept of residual demand with the total demand in the red. And when we remove the solar output and the wind output, the result is the residual demand. What is really important in this zoom at the day level is we see very clearly the impact on the rest of the system. Here, when the solar output ramps up, then the rest of the system in green needs to ramp down to compensate this. And the same happens in the evening. When the solar output is coming down, then the rest of the system needs to adapt to compensate for this. And this is the basic concept behind this very famous curve. So this is showing the impact of growing variable renewable production in California. So this is the duck curve. We can see the stomach of the duck getting bigger and bigger as the share of variable renewable production in California increased. And we can see how the neck is becoming steeper and steeper, an unfortunate conjunction of decreasing output for solar, but this is also combined with a peakier demand with evening peak. So now that we have a bit described this impact, how can we really put a quantification on this impact? First, a very concrete way of measuring it is, in case of excess, the amount of curtailment that is needed. And the impact would be also the number of hours with the near zero price, which we saw also earlier in the case of EU. One implication of this is that it would decrease the attractiveness in new projects. So if we don't tackle the integration projects, new renewable projects would be less and less attractive to investors. And in that case, this would compromise the pace of change. It would compromise the pace of energy transition. So we need to avoid or at least limit the extent of this implication. And the good news is that we have several integration measures that are available to policymakers, to policy planners, and for markets. We can summarize this in increasing the flexibility of the power system, energy storage, demand-side management, as well as interconnection between demand areas, between countries, between regions, and the role of that would play network transmission and distribution grids. So these four categories, I'll come back to this in the next slide. You can see how these four main categories here displayed in that graph with different colors. For example, flexible generation solution is in blue. So we can see how these categories, they fit in the general flexibility landscape with decentralized options, the decentralized solution at the bottom, and utility scale solution on top. And these options, they are ranging from very, very short-term flexibility within the minute or even a second time frame. So this short term is on the left, for which we can see, for example, storage that is quite well suited, and very long-term arbitrage, seasonal arbitrage, where, for example, grids would play a role, and flexible generation is a bit everywhere in this landscape. So we have seen that we have flexibility needs at the second time frame, at the seasonal time frame. One way of measuring flexibility needs can be also at the hourly level, and specifically the hour-to-hour ramping needs to fully integrate wind and solar PV and respond to change in demand. So here you can see those needs in 2019 in 4 major regions. Each dot here is representing an hour of the year. So for example, across the entire European Union, we can see that a very large upward change in dispatchable output from 1 hour to the next was needed, and about 20%. This happened when demand was rising and both solar and wind power were declining. So this is today, but in the future, flexibility needs will be much, much higher. The changing shape of electricity demand and the strong growth of solar PV and wind power, together, there are increasing flexibility needs in power systems around the world. So average hour-to-hour ramping needs almost double across most major power systems to 2040, with very much higher increase in some systems. We see a striking trend for India, where in certain hours, we will see the need for dispatchable sources to ramp up or down by well over 50%. The good news is we have those flexibility sources that I talked about earlier: power plants to electricity network, storage technology, demand side response measure. So coal and gas-fired power plants are today the main source of flexibility, and they remain so in the future. There are also some contribution from low carbon sources like hydro and nuclear power. But looking ahead, many power systems will need to rely on other means. Storage and demand side response will play a central role in flexibility, provided that we have the right policies and regulation to make this happen. And of course, on top of all these sources are grids. So solutions exist. They have a different range of impact, and the optimal mix of this solution would depend really on the characteristic of each power system.